Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. Hello, David. How are you?
Hello, Sarah. I'm very good. Thank you.
Good. Before we get to this week's topic, quick fire numbers round. What's your number?
Yeah, let's go first. My number is actually a ratio. It is 5-2. And if anyone who's listening follows me on LinkedIn, there's a theme that's sort of been running through my recent posts, which is this concern about tariffs. We talked all about tariffs in our US podcast. And also I mentioned the volume of transatlantic trade between EU and the US in our European podcast, where we talked about the Draghi report. So 5-2 is the ratio of mentions of tariffs on conference calls in Europe with European companies on the Stock 600 versus US companies as measured by the S&P 500. So European C-suite level individuals are very concerned about transatlantic tariffs.
Yeah, and we've talked about tariffs, as you say. We talked about it in the last one we did on the US elections, because it is a hot topic on this presidential campaign, isn't it?
It is, because it all links back to the swing states in this election cycle, which are the old American industrial heartland, and particularly states like Pennsylvania. And as we know from polling data and economic data, that the public tend to like tariffs, at least marginally approve of them.
Yeah,
economists nearly resoundingly disapprove of them.
Mm-hmm. Okay. My number is 1 billion.
It's a nice round number, isn't it? I'm always suspicious when numbers are that round, like prices ending in 99 or deadlines on a Friday, for that matter. It feels contrived, but come on, enlighten me.
Well, the number came from my very in-depth research in the Bodleian Library. £1 billion was the level of UK government debt at the end of the Napoleonic Wars.
Brilliant. That's a great number.
And interestingly, and this does relate to this week's topic, that was 200% of GDP.
It's a common theme during wars, and also we should do a podcast on this. There's some incredible stories about how the Bank of England during various wars or colonial expansion financed things at 0%, which put the British at a huge advantage compared to European counterparts that had to pay commercial yields, commercial rates on their borrowing.
Okay, so there's a clue there. We are going to be talking about debt, aren't we? Because there's a big wall of debt coming in 2026, apparently.
Yeah, I mean, the numbers in debt are just so astronomically enormous. I'm not sure even the human brain can get its head around how big they are. So the US right now is in uncharted fiscal territory. And on Friday last week, the US Treasury reported a deficit of $1.8 trillion for the fiscal year 2024. And that's a record outside of the pandemic. So, we're in this world of debt where numbers like 200 billion are frankly rounding errors. Yeah. And I think it's right we talk about debt. Now, obviously, those of you out there that are students of history will know there's been various sort of debt-driven cycles and debt crises over the last few hundred years. So it is important we sort of understand debt, the dynamics of it, and just the numbers as well.
Okay, so how are we going to break this down into three themes then?
Yeah, so I thought about this, and I think let's first of all talk about debt itself. Why are governments even borrowing, and what are the kind of numbers showing us? And there's some good IMF data that's out this year and actually in the last couple of weeks that talks about debt and the trends in the debt market. So we'll talk about global debt levels and projections, and then I think we need to talk about the so what factor. So these numbers are big, but are they sustainable, and what are the implications of that mountain of debt? And then the third point, which I think is really interesting, and I'll try not to make it too technical, it's about the debt markets and the dynamics in the debt markets and this idea of how much liquidity there is out there, and refinancing risk and things like that. So we'll get a little bit into the market dynamics.
Good, yeah. And I'd like to know, we can perhaps talk about bond markets, but also equity markets as well, and whether this has a negative or a positive impact. Okay, let's kick off then with global debt levels, which I saw a figure that, is it by the end of 2029, debt is set to be close to 100%. So global debt is set to get close to 100% of global GDP by the end of 2029.
Yeah, so we're talking pretty much about public debt here, global public debt. This is the IMF data I alluded to. I mean, this year, the levels are projected to exceed 100 trillion globally. And then you're quite right. I mean, it varies. I mean, the IMF actually is one of the the great things about that IMF report is they look at different scenarios. So the number by the end of the decade, yes, you're right, is around 100% of global GDP, somewhere between 93 and 100, I think, is the likely scenario. So there is this giant mountain of debt, but this isn't anything new. Okay, so we've been debating, is debt a problem and is there too much debt for decades and decades now? And the IMF data set shows one sort of resounding truth, which is that governments have successfully taken on debt increasingly over the last 150 years. And why have they done that? Well, the big picture themes are changes in demographic, changes in welfare systems and social security. And, you know, you've obviously had crises along the way that compel governments to borrow. But the overarching trend has been driven by structural factors. And governments everywhere are just borrowing more money. And I suppose there's two main reasons why we've done that. And one I already alluded to, but, you know, there's a good reason and a less good reason.
Yeah. So the good reason is, I guess, if you're borrowing money to invest in things that are going to encourage your economy to grow longer term, which I guess is what infrastructure, education, healthcare, those are generally seen as good, in inverted commas, things to borrow money to spend on.
Yeah. You're absolutely right. So borrowing for investment. So you're financing, like you said, education, technological advances, infrastructure, things like that. And then the idea is then you get a productivity pop from that investment, you increase future tax revenues, and the debt then pays for itself. So you kind of grow your way out of that debt. And there's great successful examples like that. Your textbook example is post-Second World War, the Marshall Plan, US investments in Europe to help reconstruct and spur growth. Not only did it stabilize international markets, but it created this huge post-war recovery. And you can even argue that China, and we've talked a lot about Chinese debt and the issues with Chinese debt, but amongst that sea of liquidity that's been created in China, there was substantial investment in Chinese infrastructure, Silk Road Initiative, various Silk Road initiatives, which have been instrumental in China's rapid economic growth. So that's the kind of good flavor of borrowing. Yeah. And then you've got I think I called it less good. I'm loath to say bad, but an economist would probably say it is bad. And that's the type of borrowing that covers short-term needs. Okay. But there's two types of that. There's short-term crises, and it's absolutely right that governments borrow in crises and stabilize markets.
I was going to say, as we saw during COVID.
Absolutely. So COVID's a great example there of the ballooning in borrowing and stabilizing economies throughout the world. But then there's just borrowing for general expenditure, and I suppose the Greek debt crisis, you know, typifies that type of borrowing. And obviously the dominoes were sort of pushed over in the 2008 financial crisis that ultimately slowed economic growth to such an extent and adversely impacted the lending markets. That meant a few years later in Greece, you had this collapse effectively that had to be intervened, where the ECB had to intervene. It was ultimately excessive borrowing for public sector expenses that drove that Greek debt crisis, and similar patterns in Argentina and South America as well.
Presumably because there's not going to be any economic growth off the back of that borrowing. So the chances of you being able to service that debt properly are diminished, I guess. And why 2026? I mean, I've read this 2026 wall of debt. What is it about 2026 that seems to be so important?
Well, we'll come on to that a little bit in the third section, because there is this huge volume of corporate debt. Because we talked a bit about public debt, but there's also a significant volume of corporate debt out there that's going to mature. Okay, right. So and we'll talk a bit about that, because there are various financial innovations, certainly in the private sector, that have happened over the last few decades that have meant there's less sensitivity to rates. But ultimately, debt does need to be refinanced. So the numbers right now, because we said we would talk about levels and projections. You know, the issue with many projections, and the IMF touch on this in their report, is that we're very bad actually at estimating debt levels. And what I mean by that is that we have this inbuilt bias, an optimism bias in debt projections, and the IMF note it, that we tend to think we're going to have less debt in the future than we actually end up with.
Okay.
And there are lots of reasons for that. There's a technical reason, which is about where there's a kind of accounting issue with debt that's effectively arises as a guarantee that the government has made on a state-owned enterprise. And there are big liabilities out there potentially. So if you have a state-owned enterprise that defaults, then ultimately that debt gets borne by the taxpayer. And the IMF estimates there's quite a lot of that out there. There's about this big pool of unidentified global debt liabilities. That's one reason. But then also there's this optimism bias that I mentioned, that debt to GDP ratios typically exceed forecasts by around 10 percentage points over 5 years. So the point is that we're just very bad at forecasting how much debt we're likely to have. And this IMF try and help people out here. They help both market practitioners out and policymakers out by saying, look, here's a framework where you can model different scenarios. Okay, because no one could possibly predict a global pandemic in the years prior to 2020, even though we all knew we were massively overdue for one. The point is that these things do happen unexpectedly and create different outcomes.
So the point is that the level of government debt around the world is going up, and it's going up in its relation to GDP. It's increasing. It looks like, certainly according to people who sort of researched this, whoever wins the US presidential election in November, there is going to be a huge increase in the federal budget. That seems to be clear. So I guess my question is that sustainable?
Well, this is the second topic. So clearly these numbers are big, right? US deficit, sorry, the US debt there's two measures of it. You either look at the debt public hold or all the other debt, that sort of intra-agency debt that's owed between various pillars of the government. So the number is either around 100% or 124% of GDP. So whichever way you look at it, it is massive. And that's a lot bigger actually than the equivalent numbers in Europe. And the average in Europe is around 90% of GDP. I mean, Italy's higher than that, around 145%, and Greece even higher still. So the US number is large, but remember the US has this exorbitant privilege in that it issues debt in its own currency. So it doesn't, the world is a dollar-based system, and the effects on the dollar aren't necessarily linked. I mean, they are partly linked, but they aren't completely linked to the amount of debt or the debt market's view of US treasuries. So the US has always been in this privileged position, which has allowed it perhaps to have a higher level of debt than would otherwise it would otherwise have the ability to issue. And particularly, you can just contrast like the US with Argentina to make that point. When you issue debt in your own currency, it's a much different calculus than if you're issuing debt in dollars as the US. So the point about sustainability, though, I think is really interesting. So when you go and look at net interest payments on debt right now, they're probably the third biggest item in public spending in many countries. And in the US, they are the third biggest item after defense and social security.
Yeah, I was going to say, I saw actually that the Budget Office is predicting that by the end of this year, the US will spend more on interest rate payments than they do on national defense.
Yeah. And people immediately say, aha, okay, what's going to happen now is we're going to have these big crowding out effects. Because obviously you're spending government expenditure now on interest payments, not on the investing into the real economy. And there's this crowding out, therefore, that debt payments then become ultimately deflationary. And that was what Japan's experience was. So you had this long-term deflation because the government effectively had to service those really high debt levels and divert funds into interest payments and social security rather than growth enhancing investments.
Yeah.
So the point, though, and this is the key takeaway for listeners, I think, which is that those net interest payments don't just vanish into a black hole. Okay, public sector liabilities, remember, are private sector assets. So all of this mountain of debt, who owns it? 401ks, pension funds, institutions. So as the US is paying that net interest, those interest payments, they are effectively going into the private sector as receipts for those debt holders. Okay, so you get a yield. You own a US Treasury, you get a yield, and that's actually sort of, that's the side I think that a lot of people forget. Okay, we can say that 30%, I think that's the approximate number of US debt is owned by overseas investors. So there is some slippage, some leakage of that money that goes abroad. But the point is that it doesn't just vanish into a black hole. Remember, public sector sort of deficits are private sector surpluses, typically the double entry bookkeeping. But the thing we have to bear in mind, though, is that this is all about management. It's not about levels. It's not about a number. It's about how do you manage responsibly the fiscal policies that are needed to service that debt without taking an extreme view one way or the other, without being entirely reckless and borrowing more money and ignoring fiscal policies. And I'll go out on a limb and say it's been remarkably peculiar the last decade, with governments increasingly borrowing as the economy is at full employment and doing really well.
Yeah, I was going to say, just going back to your point about crowding out, I did see that private investment falls by 33 cents for every $1 increase in the budget deficit.
Exactly, and that is the point. And as I said, Japan is a good textbook example of that effect in real life, which created effect. That's where debt deflation theory has sort of been proved, and that was Irving Fisher's theory that basically says when you have these really high debt levels, you can trigger deflation because either debtors are forced to liquidate assets, or in the case of governments, they might privatize assets, or you have to just direct what would otherwise be government investment into debt servicing. It drives down prices, reduces economic activity. So Italy had that similar experience to Japan as well. I mean, deflation's the real killer here for debt, because you can inflate your way out of the debt, of course. I mean, that has political consequences.
Yeah.
You can grow your way out of the debt, which is almost the same thing. And then you can have deflationary spirals because you have high mountains of debt. And that's what you really need to avoid, because obviously deflation makes your debt ultimately bigger.
Yeah. And arguably, large budget deficits today are going to impact future growth and higher future living standards, unless you're borrowing to spend on, that was we talked at the start about investing in the future rather than just servicing your day-to-day running costs today.
Yeah, exactly. It's all about the fiscal policy mix. It's about fiscal responsibility. So my counter to people that are overly concerned about the US is sort of split into three sections. Well, there's the exorbitant privilege point, which we talked about. Then there's the point that all of these interest payments don't just vanish into a black hole. They ultimately go into the private sector and into the real economy. And then the third point, which is actually, if you go and look at tax to GDP, tax revenue to GDP, the US actually has quite a bit of headroom, certainly compared to Europe. So if you look at tax to GDP ratios and compare the US, which is around 25% of GDP, with some European countries like France and Italy, who have tax to GDP ratios in excess of 40%. So what I'm saying there is that the US, with the will and the inclination, could raise taxes to service debt. It obviously comes with big political challenges, but this is why fiscal responsibility is so important. And the bond markets do appraise that. They're not benign to what's going on here. It's like they know these numbers that I've been giving you today. The bond market is incredibly efficient at assimilating them. And if you look at the US deficit through the bond market and compare deficit to GDP, okay, so the US deficit to GDP, deficit, not debt, is annually around sort of 6% of GDP. Germany is about less than half of that, around 2.1%. The UK is around 4.8%, and Italy around 5.5%. Long-dated bonds actually kind of reflect that. So if you look at how the market prices US treasuries, if you go on Bloomberg today, look at the 30-year treasury, it's yielding around 4.5%. That's not far off the Italian bond yield of 4.1%.
Okay.
Germany, obviously less than half at around 2.6%. So the point is that these numbers are being assimilated by the bond market, and that the bond market will just focus on fiscal responsibility and sustainability. It's all about servicing. It's not about levels.
Yeah, and actually, well, we're talking about the bond market. I did see, and I don't know what the latest figures are, but clearly France is coming under some scrutiny at the moment because of their budget. And I saw that the yield, last time I looked, the yield on a French 10-year government bond was actually higher than the yield on a Spanish 10-year government bond, which seems remarkable.
Well, this is the key, isn't it? And we'll touch on this in the third section as well. But it's about governments will want to pay very close attention to yields, because ultimately yields affect underlying economic activity. We've had a slightly different situation in recent times, and particularly I'll use the US as an example, is that the private sector has effectively, through accessing financial innovation over the last couple of decades, insulated itself entirely against some of the recent rate rises we've seen. So what do I mean by that? I mean that if you're in the US, you've been able to probably refinance your house in the last, well, prior to this rate rising cycle, you've probably been able to refinance your house for somewhere in the region of 2.6 to 2.7% interest rate for 30 years. You've been able to lock in. So people wonder why the US consumer hasn't reacted to this rate rising cycle. Well, that's exactly why. But the housing market does adjust. All it means is there's no first-time buyers coming into the market. You artificially limit the supply of property. Even though the demand has fallen, house prices go up because of that supply side factor. Now, the thing about fixing rates has meant that some of the traditional sort of transmission mechanisms for rates into the real economy haven't worked perhaps as intended. But governments are not benign to the yields creeping up, or institutions and central banks aren't benign to yields creeping up, because there is a way out of this, which isn't inflating your way out of it, or necessarily even growing your way out of it. It's effectively what's called financial repression. And we know that most recently, I mean, there's a few ways to do financial repression, but what I'm talking about there is QE.
Yeah.
And by artificially buying bonds, you can push yields down. And I think when we talk about debt sustainability, I think listeners should always remember that I was going to save this for my conclusion, but I think I'll put it in now, which is the point about public debt, listeners. And it's what Maynard Keynes said almost a century ago. With public debt, the point is we owe it to ourselves.
Yeah.
Okay. It's not like private debt, which has a whole different calculus. With public debt, and when discussing national debt, we should emphasize that it differs from private debt as it represents an internal obligation. So governments have flexibility with how you deal with it. And financial repression and QE is one way you can deal with it. So you can push yields down, so that we're not necessarily going to see those same kind of crises we've seen in distant history where yields just keep going up, because governments can ultimately come in very carefully through periods and just push yields down again by intervening in the bond market.
And how much is that dependent on whether, like you talked at the beginning about how the US has this, they're in a very privileged position that they issue debt in their own currency, and there's a global demand for US treasuries. Does that ability to be able to do that depend on the country that's issuing the debt? Are the US in an unusually fortunate position in that situation?
Or the ability to do QE? Not really. There are internal political consequences of it, because ultimately, but then the currency markets might not be, benign to it as well. It is a very delicate balancing act that central banks have to do when they do QE. So it's been done in the US extensively, in the UK extensively, in Europe extensively, in Japan, of course, as well. It's not something that's unusual, and I think that's probably, when we think about the implications of this big pile of debt, I think the implications are that central banks may, through certain periods, need to expand liquidity in bond markets to deal with things like refinancing, and that's effectively QE.
Okay, so then I guess our final point then is talking about, I don't know, what do you want to talk about? Some market risks and sort of the policy implications of this rising debt.
Yeah, so we've talked a lot about public debt, but there's also this big pool of private debt as well, and there are refinancing risks coming up. So You need to refinance about $50 trillion worth of debt annually in the markets. Right. That's a big number.
Yeah, that's a big number.
And there is this idea of this maturity wall, and you alluded to it right at the beginning of the podcast, which in 2025, 2026 is coming, where you have a significant volume of corporate debt that's going to mature, and you need to refinance it potentially at higher interest rates.
Yeah.
Okay, so that could strain markets. Now, I've already mentioned one way out of that, which is the policy recommendation for liquidity management, or QE. But in the past, it has strained markets. That's how you saw the Asian financial crisis in 1997, 98 play out. And to an extent, that was part of the global financial crisis story in 08, 09. So if you go and look at debt to liquidity ratios, so the ratio between total debt available and the liquidity to ultimately transact on it, historically, a ratio of 2.5 times has been pretty stable. But 2008 crisis, the ratio was around 2.9. And then if you look at what needs to be refinanced in the next couple of years, you're looking at that ratio going up to around 2.7. So it's causing potentially, well, it might cause the market to creak and strain. And that's where you would need central banks to come in and provide liquidity and stabilize markets. So these things aren't, remember, there is so much financial plumbing that happens in particularly in the debt markets, that is quite unseen to a lot of people. And central banks are generally now pretty focused on these kind of things compared to what they were a couple of decades ago. I mean, the financial crisis taught some very painful lessons, I think, to multiple central banks. So I would expect one of the implications to be, again, we're talking about financial repression. We're talking about pushing down real interest rates. And the best way to do that is QE. And it provides liquidity, stabilizes yields. I can see more and more of that coming.
Could we see then, focusing on markets, we could see bond markets punishing countries for what they might perceive as unsustainable debt, as we have seen the so-called bond vigilantes, as we've seen recently, without alluding to any specific cases, but we have seen that happen. What about, and obviously, again, coming back to the US, they're in a particularly sort of fortunate position. What about equity markets? Does this impact equity markets because of concerns about economic growth in the future and how that's going to be impacted by unsustainable levels of debt, or just very expensive levels of debt? Maybe not unsustainable, but costlier levels of debt.
Yeah. So for your first point, which is about the bond vigilantes, there is obviously not just renewed interest, but there has always been intensive focus on fiscal responsibility. And you saw that very acutely, obviously, with what happened with UK gilts in 2022. And all over the world now, policymakers are watching very carefully how capital markets behave. So fiscal responsibility is very, very important. And how equity markets might behave. So you have to bear in mind the bond markets globally are pretty much the foundation of all financial engineering. So when you want to take a company private or do some kind of leverage buyout, or when you want to expand a business or borrow to invest in capital, that financing ultimately happens on the bond markets. So strains in the bond markets, when it's liquidity driven or yields perhaps spiking, which is ultimately the same thing, can cause the equity markets and particular parts of the equity markets problems. So you have certain sectors that historically have carried lots of debt. So utilities, as an example, utility companies have carried lots of debt because they tend to borrow lots of money because they have giant projects to invest in. That can be painful. And then in private markets as well, where you have leverage buyouts happening, that can be very painful. So there are strong interlinkages between debt markets and equity markets, to the extent that debt is used to finance or do some kind of financial engineering.
Okay, but ultimately, so we're saying that there's a lot in the press at the moment about levels of debt, levels of government debt, levels of private debt. There are concerns about, over the next year or 2 years, a lot of that debt is going to have to be rolled over. Is that going to be doable? And how much is it going to cost to do that? And in the past, we're saying we've had major events that have been triggered by debt crises. We're not saying that's going to happen this time necessarily. And we're saying now potentially then, without wanting to sort of be too Pollyanna about it, central banks are probably better placed now to understand the tools they need to employ if this were to happen again.
Absolutely. So you have to look at this mountain of public and private debt. And with public debt, remember, we owe it to ourselves. So there are lots of policy tools that are available to provide liquidity to the markets and undertake what's called financial repression. With the private markets, you have this idea of debt service ratios, which is your way of measuring your ability to service your debt. And remember my earlier point, through financial innovation, we've kept the servicing requirements for a lot of this debt extremely benign, extremely low. So I think when you look at the US, you've got a debt servicing ratio of around 15%. It's much lower than other countries. So I think the chances of any kind of debt precipitated crisis are extremely low. But we are confronted with the same conundrum we were confronted with a few decades ago. How do you use debt to enable growth and not just keep piling it up? As you increase the absolute number of debt, obviously the market gets very focused on servicing. But there is no limit. There's no number. There's no magic number where it becomes unacceptable. It's about growth and about fiscal responsibility. It's about that and the dynamics of the market from a liquidity perspective and a financial plumbing perspective. That's what's really important to focus on, I think.
Okay. All right, then. Thank you very much, David. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you for listening. Until next time on Need to Know, bye for now.